Well, good morning and welcome everyone. This is James Orr, and today is going to be a pretty interesting video. Um, I'm sort of going to take it really, really easy at first, and then I'm going to go to complete freaky town. I'm sort of calling this video a little tongue in cheek. Can your financial planner do this? So let's get started walking through, modeling. In this case, I'm just going to say, you're a 40-year-old person who is got a little bit of money saved up for retirement, and you want to evaluate, some different strategies for getting to retirement and how they kind of are impacted by a variety of different things. So let's just start there, and I'll kind of walk you through it as we go. So I'm in the Real Estate Financial Planner software, realestatefinancialplanner.com. I'm going to add a scenario, and I'm going to start off really, really basic. I'm just going to say, earning. I'm going to number these so that they stay in order. I'm going to say earning 5K per month. And then we'll just start with that. And so since you're 40 years old, we're going to model this for 60 years in the future so that this models through age 100 for you. And so I'll do 720 months for doing that. The effective income tax rate, since you're going to be earning, I'm going to say you're earning the national average for income. So that's about $60,000 a year, about $5,000 a month. And so the effective tax rate for that, you can look it up here doing this, but I happen to know, I think it's 18.8 something actually. Why don't I just look it up? So I'll go in here and I'll type in household income 60,000. I'll just do it for where I'm located, but you can do wherever you're located. I'm doing Greeley, Colorado. I'm saying you're married. And so your effective income tax rate right here is 18.84. So 18.84%. I'm going to say the inflation rate is 3% because we're going to be able to model this and take into account inflation in the future. Mortgage interest rate 4.875. We'll just leave that as that for now. We're going to set it for individual properties. And then we're going to say you want to have the same income you're enjoying now from your job in retirement. So we're going to say your target monthly income in retirement is $5,000 as well. And then based on the Trinity study, we're going to assume for now that your yearly safe withdrawal rate from any investments, your stock market investments, your bond investments, your cash investments, anything like that, that you're able to take out when you retire 4% per year from your account. So we're going to set that as our target yearly safe withdrawal rate. If we were going to do Monte Carlo, we would do that here. I'm going to set this up so that people can download it as a sample, and I'm just going to save that as a default. Next thing we're going to do is we're going to set up an account. And so I'll go up here to accounts. And in order to simplify things, I'm just going to start off with one account that really does everything. It's not going to be separate accounts for your stocks, separate accounts for your bonds, separate accounts for your retirement accounts. I'm just going to say you're going to keep all your money in one generic account, and I'm going to further make a very silly assumption and say that you are investing all the money in that account in the stock market. So I'll just call this your stock market account. And we're going to open it at the very beginning, so you leave the date blank. Opening balance, we're going to say you start with $50,000 in it. So you're 40 years old, you've managed to save $50,000 towards your retirement so far, and let's go ahead and use that. As far as return goes, I'm going to use 8. I'll just use 8%. 8% is based on a really, really rough number of what the stock market might have performed over the last 100 years, depending on what you had it invested in. So I'm just going to use 8% as kind of a starting point. I'm going to get really complicated here in a little bit, and we're going to use a range of values and do some calculations where the stock market may do better some years than others or some months than others. And so right now, though, I'm starting with a fixed 8% return, and we're just going to start there. So just make sure I save that. And then go back to the scenario, and I'm going to add that account to the scenario. So go down to the account section, and I'm going to click on this little plus icon to add it to that account to this particular scenario. Now you can show it shows up as green. Okay, and now properties. So we're not going to do any properties in this one yet. I'm going to do that in the next scenario, but I am going to add a rule for you to have your income coming in. So these are rules. Rules manipulate things like accounts and properties. So we're going to do a rule for your paycheck and your personal expenses. And in this particular case, I'm going to say that you are doing this just with this earning 5K per month one, and that we're going to deposit it into your stock market account, and we're going to withdraw it from your stock market account. Your paycheck is going to be a gross of $5,000 a month. And I'm going to check this box off, which basically says, once you reach the point where you have enough investments between your real estate and your safe withdrawal rate from your stocks or your bonds or whatever it is, once you and your safe withdrawal rate from that money, once you reach that point, I'm going to stop your paycheck. So I'm going to assume that you stop working. So I'll check this box off to stop working there, and we'll start with that. Then your personal expenses, I'm going to say they're $4,000 a month. And I'm also going to say that of that $4,000 a month, you're spending about, we'll call it $1,200 a month on rent. Okay, so that's what your rent is. And if you're going to buy a property, which we're going to do here in a little bit, then you'll actually reduce your personal expenses by this $1,200 because you're no longer paying rent, but you will have additional expenses from the real estate, which is calculated separately. I'm also going to say that these are inflation adjusted. So $5,000 that you're earning now is going to increase over time with inflation. So are your personal expenses. So is the dollar amount you're adjusting for your owner-occupant property. And then this tax rate here, that's that 18.84 that we had from before. Okay, I'll just save that. And it will show here that you're able to save about $58 a month towards your retirement. $5,000 income, subtract out your tax rate, and subtract out your $4,000 in expenses, and you're left over with about $58 per month in month one, if you were doing that. Okay, so let's go back to the scenario. Now we got a really basic scenario set up. I'm actually going to run the scenario, and it will take a minute or so for it to start running, and then we will start adding in additional complexity and additional modeling so that you can see how doing different things like adding real estate and having variable returns in your stock market and having Social Security for you and your spouse, all these different things kind of play out. So we'll do that here in a second here. Let's just see if it's run. So usually the software runs about every minute, but you do get queued. So if there's a lot of people waiting to have their stuff run, it could take a little bit. It should be done here in a second. All right, now it's done. So let's go ahead and just pull up a quick chart, and I'll show you just a couple really quick things on this before we start adding complexity. So this shows you your net worth. You start off with that $50,000 or so, and you're adding about $58 a month and getting interest at a rate of about 8% per year. And it is compounded monthly here. So you can see that your number continues to grow until finally, when you're 100 years old, you have about $6.4 million in inflated dollars in the future in your net worth, and you're basically in your stock market account. If we adjust for inflation by clicking this inflation adjusted number, you end up with just about $1 million in today's dollars at some point in the future. So what I'll do is I'll show you. Let's just look at total saved to give you an idea of how much you're saving. So this is inflation adjusted. So you're saving $58 a month forever and ever and ever. And interestingly enough, in this particular case, you can never stop working because you never get to the point where you have enough money so that your safe withdrawal rate is enough to do that. And so the software says, hey, listen, you never get to stop working. You're working till 100 in this case. So let's go ahead and add some reasonableness back into that. So let's go ahead and make a copy of the scenario. And I'm just going to call this number 2. Stop working 25 years at 65. Actually, let's just do 20 years. Let's say I'm not working past 60. Okay, so we'll go ahead and do that. And I'm going to go down to this same rule that we had before. And this rule was set up to run for 20 years in the future. Okay, so what I'd really like to do, though, is I'd like to say, hey, let's only have the income part of this rule run for the next 20 years. So what I'm going to do is I'm going to make a copy of this rule. I'll go back to our rules here. I'll go back to our scenarios first. Go back to our things here, and I'm going to go to 20 years in the future. And I'm going to make a copy of this, and I'm going to modify them. So now I'm going to separate out the rule into one rule is going to be for income, and the other rule is going to be for expenses. And the rule for income is only going to run for 240 months. Okay, so let's call this one the income one. So months, I'm going to end this rule 240 months in the future. So month 240. And I'm going to say that's our paycheck. But there's no personal expenses in this one, and there's no adjustment for being owner-occupant, but I will still adjust for inflation. So now this is just our income part of our rule, and it only runs for the 240 months. Now I'm going to go back into the scenario, and I'm going to edit the same rule I had before for the personal expenses. So now this is the expense one, and this one should run for the entire duration, but there's no more income. It's going to be zero. I still have $4,000 in personal expenses, and $1,200 of that is still my owner-occupant property, but in this case, I'm going to say that our personal expenses run, and that runs for the entire scenario. Now, if we rerun this, what does that look like? So it's kind of queued up to run. So like I told you, I'm starting off like incredibly simple, and this is going to become incredibly complicated to model. Someone buying some real estate, and they stop working early, and maybe they have a side hustle for a period of time, and the returns they're getting from their real estate is variable, and there's market corrections and all sorts of craziness. So let's see what happens here. All right, now it's stopped running. Let's take a look at the chart. Oh, look at this. So in this case, you say, hey, listen, let me zoom in on your account. So we're going to go look at your account balance. We'll look at just your stock market account. And so it shows you that you start off with 50,000, you end up saving a little bit, and then by the time you get to the point where you are 60 years old, 240 months in the future, you say, enough of this working nonsense, I'm going to stop working, and I'm going to start just pulling my living expenses out of my investment account. And at that point, you had about $273,000 saved up, but you could see by taking out, whatever your the equivalent of $4,000 in personal expenses each month out of your account does, you end up running out of money very quickly. You end up running out of money in month 282 or something like that. So that's not good. Okay? So that's kind of the problem we're starting with here. If you don't get to the point where you have enough money saved up, then you run out of money in retirement. So let's see if we can change some stuff right that. First thing, let's do this. Let's have you buy a property and see how that impacts some stuff. I have a feeling it's going to get worse before it gets better, but let's go ahead and just add in here that you're going to buy a property. Okay, so we'll do number 3. Buy owner-occupant property. So everything stays the same, but I'm going to go add in a property. So I'm going to make the property first, add a new property. And I'm just going to call this a 3-bed, 2-bath, or I'll just call it a typical property. I'll call it typical 4-2 single-family home. Actually, I'm going to call it a typical property. It doesn't really matter. I'm just calling it this so that we can identify it. You put in your city, state, and zip code if you want to. The system doesn't use that at all. I'm going to say this is a $200,000 property. Make sure I have the right number of zeros. I do. And then the purchase price, we're going to buy it for $200,000. If you were going to be able to buy properties for a discount, you can go ahead and adjust your purchase price compared to the after repaired value, which is the value when you buy the property. So mortgage interest rate. Since we're going to buy this property as an owner-occupant, I'm going to say I just bought one as an owner-occupant, let's see, 6 months ago or so, and we were able to buy our interest rate down to 3.375. For the sake of making the math a little bit easier, you're not going to buy it down. In this case, I'm just going to say you're able to get a 4% interest rate on your property here. And then on the investor ones, we're going to have a slightly higher interest rate because your interest rate when you buy investment properties is higher than your owner-occupant one. We're going to get a 30-year mortgage, 360 months. We're going to put 5% down. Your closing costs, I'm going to estimate those to be about 1%. Rent-ready costs, you're not going to have any of those. That's because the property you're going to buy is going to be ready to move in. It's not going to need a lot of work. You're not going to get any seller concessions. We're going to say the land is worth about 15% of the value of the property. This is for calculating depreciation. I'm going to get the down payment, and I'm going to put the income and expenses from the property in that same stock market account. I'm going to say the property is going up in value by 3% per year. That's the appreciation rate, and that's based on the long-term average for Case-Shiller. But we're going to mess around with that a little bit later. We're going to show you what happens if property values don't go up by 3%. Let's say it's random. Let's say, on average it's 3%, but there are years where it's down and years where it's up and things like that. Start rent after that. I'm going to just estimate rent right now at about, $1,400. And then I'll make an adjustment here in a second for that. I'm also going to say rent is appreciating at about 3%, the same as the property value. No other monthly income from the property. We're not renting out a garage or doing anything funky like that. Vacancy, we're saying the vacancy rate, if you were going to rent this, which you're not, is 3%. Property taxes, we're going to say that's 0.65. That's based on like my local market, but your market may be different. You maybe have, you may live in Illinois or New York or something like that where property taxes are much higher, or Texas. And then property insurance, it's about 0.4% of the value of the property. No HOA. And utilities already included our other monthly expenses. No other expenses here. We're going to set aside 10% for maintenance if we were doing the management of the property, if we were going to rent out the property. And then property management would be 10% if we were doing that. And then we have a separate section here for CapEx, which in this case we're not doing. All right, so in this case, we're buying a property, and I'm going to go down here and look at some of the calculations and adjust the rent. So in this particular case, if I had $13.94.45 in rent, rent would be break even. I would have basically no cash flow as soon as I bought the property. And so I'm going to make this property, I'm going to go back and change the rent to be forced break even. So I'm going to say rent is $13.94.45, and that way when I look down here, it's going to show me that my cash flow on it is going to be $0 a month. Okay, and I just did that because I want to say, let's make this a neutral property where if you bought it with 5% down with owner-occupant financing, it would be break-even. And if you bought it with 20% down, you're probably going to have slightly positive cash flow, which we'll do here in a little bit. For now, though, I'm going to add that property. I'm going to go back to that scenario where it says buy owner-occupant property. I'm going to add a new rule, and the new rule is going to say, go ahead, buy a property when I have enough down payment in my account, and in this case, we're going to have enough down payment to do it. So I'm going to do this just for that buy owner occupant property. I'm going to buy the Nomad property that we just set up. I'm going to take the money out of that stock market account. I'm also going to say I need to have at least $5,000 in cash reserves, adjusted for inflation, plus the down payment, plus all the closing costs in order to be able to have this rule get triggered and for me to buy the property. I'm also only going to buy one of these properties. Oh, and I want to make a note about something. I realize I am going ridiculously fast right now. Okay, this is not like a beginner, like this is how you actually pause and set up everything. And I'm kind of taking my time and explaining everything. I'm just telling you the story and setting it up for you in real time and going very quickly. So I realize this is very fast. And one of the reasons I'm doing that is because I want to get to the point where we're going to like crazy freaky town and I can show you some stuff. And I'm not taking my time to go slow. There'll be times later where we can go slow, or if you need support or tech support or something like that, you can hire us to do that if you need to. So minimum number of properties, we're going to say 1 here. And this is a section if you want to be able to pull cash out of properties to buy future ones. We're not going to do that. So I'm just going to do 1 here. And so go back to the scenario. And now we've got that account set up. We've got this property, and we've got a rule that says you've got your personal expenses. We got a rule for your paycheck, which stops when you're age 60, and that you're buying an owner-occupant property as soon as possible, as soon as you have the down payment, plus $5,000 reserves, plus the total cost to close, your closing costs. So I'm going to go ahead and set that up. Oh, and I'm going to set up something else here. I'm going to set up a goal. I'm going to say, hey, listen, let's set up a goal for when we have that target monthly income in retirement. I'll run it for all scenarios. We'll include that stock market account and that property that we just added. And now let's go to the scenarios page. And I am going to run this scenario. And once it runs, I'll go in there and I'll show you how buying a property impacts your ability to hit your retirement numbers. It's going to be really interesting to see if you stop working at age 60. So we'll just wait for it. All right, should be done here in a second. There we go. I'm going to open this up in a new window. Look at this. Okay, so now that we bought a property, it extends out the period of time. Got a little bit longer than it was before. And let's go do this. Let's go compare total account balances, which shows the account balances that we've got there. And I'm going to compare this one to the one where we stopped working, where we didn't buy a property. And you can see where the one where we bought the property, we have money for a longer period of time. Okay, I'll zoom in a little bit. You can kind of see the difference there. Okay, and you can see that we end up having more money by buying the owner occupant property than than not buying that property. Okay, so we're heading in the right direction. Let's see what happens though. Oh, I want to make one more mention about something. So if you wanted to, like, let's say you were going to do this modeling on your own, you could go to properties and you could add any properties that you currently own. Like, let's say you were doing this to model your own stuff, because I'm going to do like a generic story. But if you really want to model your own stuff, you need to go in here and add your specific investments, your specific savings rate, your specific income and earnings power, and kind of model what you're doing, because a generic rule about, or a generic scenario where we model someone who's 40 and stops working at this time can have significantly different impact than, or different outcome than, what you with your specific investments are. So you can go add properties and add ones that you already own. So you would do that, or actually I'll make a copy of this one. Yeah, I'll wait for that. I'll wait for that for a second. So basically you could go here and make a copy, but you can go ahead and put the already owned one on there to do that. All right, so what was I planning on covering next? Let's go ahead and say, go back to the scenarios. Let's pretend for a minute that we'll make a copy of this one, and that your spouse starts a side business, a side hustle of some sort, for, let's say, $1,000 per month for 20 months. Okay. So what I'm going to do is I'm going to say, let's say sometime a year from now, your spouse decides they're going to do a new little side hustle, and that side hustle is going to bring in $1,000 a month, and we'll say they do it for 20 months or so. So I'm going to come in here and I'm going to add in an additional paycheck. And in this paycheck, I'm going to say months that it runs. We're going to say it starts 12 months from now. And for 20 months, let's just call it, we'll say it's 32, so it runs for 20 months, and it only applies to the side hustle for 1K. Put the money in the stock market account, and paycheck, it's an extra $1,000 a month, and we're going to say that that is actually not adjusted for inflation. So it is a fixed $1,000 a month. Okay, so it is not like it's an inflation-adjusted number. We're not going to say it stops in retirement. We're going to say they actually do it for this specific period of time, 20 months. Now, this could be literally that they go and get a job working at the library or the climbing wall, or they decide to start a little Amazon side business. It can also mean that for this 20-month period of time, you got 2 roommates, and you rented out 2 rooms in your basement, and they got $500 a month each, and you did this for 20 months, and you decided, I'm not doing that anymore. And so this is sort of modeling a side hustle, or maybe you started a flipping business where over the course of that 20-month period of time, you were able to flip a property and make 20 grand. And so we just said, really, we're spreading it out like you're making $1,000 a month, but it's really $20,000 that was paid out over that period of time for the work you did. So you could either do a single month with a $20,000 paycheck. In this case, I modeled it like you did it over 20 months. But if you were to start a flipping business and you made $20,000 doing that, that's another example of how we would do this. Okay, there's no additional expenses. We will do the tax rate, so we're going to tax this. So you're going to tax it, no personal expenses because they're already taken out elsewhere, and there's no adjustment for an owner-occupant property, and we're not going to stop this in retirement because we're going to just do it, and we're not going to adjust for inflation. So in this case, we just added an extra little income source to do it. And if we run the analysis again, how much does getting a little side hustle help us by the time we get to retirement? In a weird sort of way, this is almost like starting with an extra $20,000 in savings a year from then. It takes about 20 months to get it, but you're starting with a lot more savings than you did before. And so let's see quickly the impact that has on your stuff. Go back here, I'll just refresh this page. Okay, looks like it's done. Open it up in a new tab. And you can see that it extended there. Let's see how it compares to the previous one where we just bought the property. And as we suspected, getting the side hustle added some additional time. Now we're able to have enough money. We didn't run out of money until like month, whatever this is. Month 409. 410. So whatever that is divided by 12. So that kind of year. 480 would be 40 years in the future, so you'd be almost 80 years old. If you're probably running out of money, 408. I don't know what 408 is. Let's see. 408 divided by 12. 34 years. So 34 years in the future, when you're 74 years old, you would have run out of money at that point, assuming you were able to get 8% in the stock market for that period of time. Okay, let's see if we can improve on that a little bit. Because you really have Social Security. So I'm going to make an addition here. And I'm going to say, copy 5, Social Security for you and your spouse. So we're going to go ahead and model in Social Security. And who knows if Social Security will be there in the future? I don't know. No one knows. We think it'll be there. So let's go ahead and add a couple extra rules. So in this case, we're going to add another income, paycheck and personal expenses. And in this case, we're going to start with a date because you know when you turn 62 or 65 or whatever the date is that you're able to start collecting Social Security. And so we're going to say your birthday's in February, and we'll start it on the first of the month of February. And you're going to say February, let's call it, let's see, we said you're 40 years old, so 22 years in the future, that would be, let's call it 2020, 2042. We'll call it 2042. We'll pretend that your birthday is in January, February of the year, and so 22 years in the future, when you're 62, we'll call that. Then you're going to start collecting Social Security. We're going to say Social Security never ends. Only applies to this Social Security one. We're going to deposit in that stock market account, and let's say you're going to collect, I don't know, $1,500 in your Social Security benefit. I really don't know. You'd have to look up on your Social Security benefit what you're actually getting. This one does not stop in retirement. In fact, it starts in retirement. And then personal expenses, we're not going to subtract any personal expense out of here because we've already got those set up elsewhere. We're not going to adjust anything for the owner-occupant part. We are going to adjust this for inflation because Social Security does adjust for inflation over time. So we'll say that, hey, this is $1,500 in today's benefit. $1,500 in the future is going to be significantly different. And then our tax rate, of course, we're going to pay taxes on that. And I think Social Security gets taxed at a slightly lower rate, but I'll use 18.84 just to kind of make it a little bit more conservative. Okay? But you can figure out what your tax rate is and do all that calculations. So this will add about $1,217 after your taxes to your account starting February 1st of 2042. Let's go add one for your spouse as well, though. And so we'll go down here, and we'll add one for your spouse. Add new rule. Paycheck and personal expenses. And we'll say this is the one that gets applied to that. It does the stock market account. And let's say your spouse did not put as much into Social Security. Let's say their benefit's only $500 a month. And let's further say, we'll adjust that for inflation, same tax rate. Let's further say that it doesn't start, let's say you married someone really young. So it doesn't start for many, many years more. And let's say their birthday is in September 1st, and we'll say, they're 8 years later. So I think we said it was 42 before. We'll say it's 50 now. So in 2050 is when they start getting an extra $500 a month because that's when they start able to take their Social Security. Okay? So that's the story behind that. Let's go rerun that analysis and see how that impacts things. Can you see how this is getting really complex? And I haven't even started with crazy rental property stuff or making things variable. So you're in for a treat. It's going to be pretty amazing. Okay, so kind of running it. I'm looking at the clock to see when it turns because I think it runs on the minute. So should be doing some stuff here shortly. Provided I did it correctly. All right, there we go. It's done. All right, so now we're going to go to chart. Oh! Totally different experience. Now we're able to not run out of money until, when is this? This looks like about 595 or about 600 months in the future. So 600 divided by 12 is about 50 years in the future. So you'll be like 90 by the time you run out of money here. Okay? So you can see you had some money and you had some irregular curves here. There's a little bit of side hustle stuff going on with your net worth. Then you actually your Social Security kicked in here, and it looks like your Social Security kicked in again here in order to do that. So you can see that your income. Actually, let's go look at just income. Let's look at your paychecks. Total paychecks after tax. Let's do gross paychecks. This now shows you your paychecks. So you started off earning from your job. You had a little side hustle bump for your income there. Then this is when you said, hey, I'm not working anymore. I'm done. I'm out of here. And you had a period of time where you had no income. Then all of a sudden your Social Security kicked in. Then your spouse Social Security kicked in. And you were able to have income coming in from that over that period of time. And the difference between whatever your income is and what you needed to live on is coming out of your investment account. Okay, it is basically just being withdrawn from your investment account each month, and we can go look at that if you really want to, but I'll do it for the sake of time. I'm not going to do that. Okay? All right. Now, what we've been modeling so far is we've been saying, hey, the stock market is growing at a fixed 8% per year. But that's probably not reality, right? The stock market doesn't give you a fixed rate of return. So what I'm going to do is I'm going to make a copy of this one, and I'm going to say variable stock market rate of return. And I'm going to add a rule. And we have a rule that allows us to modify what the stock market rate of return is. And so the rule is right down here, adjusting scenario accounts and properties. We're going to set a value on the account. So this is just going to apply to this variable stock market rate of return and the future ones when we copy them. And we will do all accounts in the scenario. Let's just do just the account. So we'll do the stock market account. And then what variable do we want to modify? We want to modify the yearly rate of return. Okay, and we could actually just set that to be a new variable, new account number right there. Or we can do something crazy, and we're going to do something crazy. We're going to actually set it to be a random value from a normal distribution. And so I went and I did some research on what the stock market has done historically. I went to Bogleheads. They have a spreadsheet, Simba's spreadsheet for historical returns. I went and looked at the overall VTSMX stock market index fund, and I did some analysis on that to show what the low end of the range of returns was, which was negative 44.433, and the high end of the range of returns, which was 65.47. And so I'll do that again, negative 44.43. 44.33, that's what it is. 44.33, and then maximum was 65.47. So now we're saying, hey, the stock market's not going to do 8% a year. It's going to do somewhere between negative 44%, which is what it did, and as high as 65%. And we're going to say that the standard deviation, which is some fancy math terms if you don't know what it is, and that the normal step curve is 0.01. Okay. So when I save that, it's now going to show me on the bottom a distribution curve and say, hey, on average, the stock market has done about 10.5%. But there are years when it's really, really negative, and there are years when it's really, really positive. But most of the time, it's going to be sort of in this 0 to 20% section, with the average for all of them being about 10% when it does this. And really the return is going to be average. So this is not like based on actual historical sequence of returns. This is like random values. So the stock market could do better or worse than what it has done historically, but it's based on some real stuff, some real ranges of values that we've done. So let's go ahead and rerun this analysis. Now, because we've rerun this analysis and those numbers are now random, each time we run this, we will get different results. Okay, so what I'm going to show you, I'm going to make a copy of this, and I'm just going to do 6A, and I'll show that this is just the same one we did, except I'm going to run both of them side by side, and I'm going to compare them. And we'll make a copy of this, and we'll call it 6B. So everything is exactly the same. I just want to have 3 copies so that I can show you that the numbers are different each time we run it. All right, so it ran 6. Let's rename this 6C and we'll rerun it again. 6C. All right, so when I rerun these, you'll have 6A, B, and C. In the meantime, let's look at 6A. Whoa. So what's super interesting is you can now see that it's no longer this smooth curve because the return you're getting from the stock market is variable. And I'll even show you this. If we go and look at the account charts and we look at the yearly rate of return is now random. Before, it used to be this fixed number at 8%. It was a straight line. In fact, I'll show you. Let me go pull up the previous one, 5. If we go look at 5, when we had a fixed rate of return, and we went to accounts, and we looked at yearly rate of return, you could see that the yearly rate of return for the stock market was this fixed 8%. That's not true anymore. Now we've got this variable rate of return where some years it's really high. I mean, it's like 54%. This one, it's an annualized amount, but it's actually calculated on monthly. So it takes, the 1 month of that, rate, at a yearly amount. And so you could see, though, that it's doing some years where it's really negative. I'll zoom in. You can see it. So this month, it was actually negative 41%. This month, it was positive 33%. And so you have these kind of like random values for your yearly rate of return. And they'll be different if you run this again, as I said. So let's go back and we'll look at the chart. Let's look at a couple things. I think all these should be run by now. Yep, they are. All right, so it shows you that the yearly return there, but it gets smoothed out a little bit later because the income from your money coming in is going to impact that a little bit bigger. So let's go ahead and do this, though. Let us look at let's see here, total return. What am I looking for? Total. Well, I guess you could do it in net worth too. All right, so let's do this. Let's compare 6B and 6C. The same assumptions. Oh, this actually worked out amazingly well. And it's random. Like, I couldn't have planned this. But this works out like remarkably well. It shows you that these are 3 of the exact same scenario. You're collecting Social Security. You've got that little side hustle for 20 months. You stop working after you're 60 years old. And it shows you if the stock market goes with you, then in the red example, looks like you have enough money to get you to 100. You end up with, almost $1 million in your bank account. Let's just zoom in on, well, I won't do that. So it looks like you have over $1 million saved up because the stock market did really, really well for you. But the orange one it did intermediate, so it did okay. You end up with $347,000 in inflated dollars at the age of 100, and you didn't run out of money. But with the yellow one, it shows you ran out of money. So what's crazy about that is this is a perfect example, and I couldn't have planned it any better, and it's really random, so I didn't do it. But it shows you that one example, you ran out of money when the stock market didn't do well for you. Another one where you had enough money, but it looked like it was on the decline. You're probably going to run out of money. And the red one where you actually had money and you probably had enough to continue going. Okay? So we can go look at those and see that impact. So there's a chance you do it. Now, I'm not going to go into this here. But if you wanted to, like if you were going to go in here, you could actually run this exact scenario more than one time. The Monte Carlo simulation would allow you to run this thing. Let's say you wanted to run it 100 times. You put in 100 here, and it would run it, and then it would summarize your results instead of showing you like one line that shows you like what your balance in your stock market account is. It'll actually run it 100 times, and it'll show you what your range of values are. So then it will run 100 different copies of it. It's almost like that ABC thing, but it'd be A through whatever 100 of letters are. Okay? All right. So let's go back, though, and add some more complexity because we're not anywhere near done. But this is interesting, right? I mean, you get to kind of see this account balance thing and how it happens. Yeah, I find that fascinating. Oh, here's another. Well, I guess it's not going to show you that. Okay, so let's do this. So we talked about stocks becoming variable. Now, what I'd like to do is I'd like to show you. Yeah, let's go ahead and add some rentals. Let's do that next, okay? So let's go make a copy of this one. We'll do 6A. It doesn't really matter. They're all the same. 6A, we'll call this 7. And I'm going to say buy 9 rentals. So in this model, what I'm going to do is I'm going to go ahead and I'm going to go to properties, and I'm going to say, you know that house that we moved into? I'm going to make a copy of that house. Let me make sure that I made a copy of it. Made a copy of it. And when I go in here, I'm going to edit the copy. And instead of this being a typical property with 5% down payment, I'm going to say it's a typical property now with 20% down payment. I'm going to buy it as a rental property. Same price house, $200,000 house. The interest rate, because we're not living in the property anymore, we're not an owner-occupant, is going to be higher. Investment mortgages when you buy investment properties, are higher than mortgages on owner-occupant properties. So in this case, we're going to say it's 4.5. Same 30-year mortgage on it. Instead of doing 5% down, now we're doing 20% down. And the same rent as before, same seller concessions. Everything else is identical. The only thing that's different is the interest rate has gone up and the down payment has gone up. And now, when we bought this property, it's probably going to have a little bit of cash flow. So it's going to have about $100 a month, $96.39 a month in cash flow when we bought it. Okay? And so that's what that's based on. Now let's go back to our scenario. And just like we had this rule before for buying the owner-occupant property, we're going to add another rule that says buy property when your account has a down payment. And we're going to run this one just for this buying 9 rentals. We're going to buy the 20% down payment. Oh, we got to change this that it's not Nomad. I'll go back and change it in a second. And we're going to take this money out of the stock market account. And we're going to say we need at least $5,000 in cash reserves to buy it. And I'm going to make sure that that gets adjusted up with inflation over time. I'm going to buy no more than 9 properties. And I'm only going to start this in month 2. So I'm not going to do it month 1. We're busy buying our owner-occupant property then. But I will start buying rental properties in month 2. Okay, so I went and I did that. So we're doing 9. We did all that adjustments. I set the rule up. Let me go back to our properties. And I got to toggle off that it's a Nomad property. So this one, Nomad property means you move into it, live there for a year, and we're not doing that in this case. Oh, and I want to show you this before. So if you wanted to add properties that you already own, you'd click on this button, and it would allow you to enter properties in a different form. It would ask you like what your current mortgage is, what your current mortgage balance is, how much were your closing costs when you bought it. So this is the button to click on if you've got existing properties that you already own coming into the scenario. We're using the dynamic property feature, which is sort of like templates, and I say that in quotes because it's sort of like a prototypical property that we're going to be buying multiple ones of. And the properties do increase in value over time. So like if you buy it a year in the future, it's more expensive and rents are more. And so you need more down payment to do that and things of that nature. So, but I toggled off the Nomad one because we're not moving into this property. All right, so go back to the scenario and we will run it. Buying rental properties. All right, and so while we're waiting for this thing to run, I'm going to show you something in this last one. So this is the one that we ran before. This is not the one we did. And this happens to be the one where we had enough money. So I'm going to show you the number of properties that we owned because when I show you the next one, it's going to be different. So in this case, we bought that one property as an owner-occupant in month 1, and so we only owned one property for this entire 60-year period. Okay? When we go and we run this new scenario, I'm going to show you when we buy the future properties. So let's go ahead and look at that now that it's done running. It's getting exciting. All right, this is what our net worth looks like. We didn't run out of money. Remember before, our net worth would go up and then it would come back down? Didn't happen when we bought some rentals. Let's see what's going on here. Number of properties owned. Ooh, this is interesting. So it shows you, I'll zoom in a little bit, shows you bought your owner-occupant property right off the bat. But you didn't have enough money. You didn't have 20% down, which 20% down of a $200,000 property is 40 grand. You didn't have the 40 grand saved up to buy your rental. So you had to wait. And you waited until month, whatever this is, month 15 or so to be able to buy your first 20% down rental. Then you had to save up your money for a long period of time until you're able to buy rental number 3. Then you had to save up your money until you got enough to buy 4. But you'll see it's getting faster and faster because you're starting to get some positive cash flow from your rental properties and everything's starting to compound for you. So it becomes super, super interesting that you did this. I'm going to show you this in the account form. So I'm going to look at your account balance and I'll show you what's happening. So I love this stuff. It's amazing. All right, account balance. So here's your account balance. Let's take off the stock one, and we'll zoom in. Oh, look at this. So you started off, remember we started off with $50,000 in savings or whatever it was, and that was in month one. But we had to have some money for the down payment, the 5% down payment. So we needed about, let's see, 5% of 200,000. That's about 10K plus some closing costs. So we started off with 50K, and the stock market must not have done well that first month, but we ended up with $36,000 left over in our account after we bought our first property. 10K of that was your down payment plus some closing costs. Maybe another $2,000 in there, so 12K. So stock market went down a little over $1,000 or something like that. But then we kind of kept our investments, kept saving the tiniest bit each month, and then right here we actually had enough saved up for a down payment plus 5K, and the down payment came out. And we invested that in stocks. Instead, invested that in our first rental property, and then we continue to grow our down payment over time. And then we have enough here for another down payment. Then your account balance goes back down. Another down payment down. Another down payment down, until eventually. Whoops! Let me zoom out right about here. Eventually, you bought your last rental property, and your account balance just kind of continues to grow. Okay, so that's super interesting. Now, let's take a look at a couple things. Let's look at the properties you have in their cash flow. So this shows you the 10 properties that you own. And for the sake of this, I'm just going to open up this in one window, and I'm going to show you the property that you live in. So this is the property that you live in. The first month you move in, your expenses on that property are about $1,082 per month, and then they continue to be about that. They increase with tax and insurance over time, and then eventually your mortgage gets paid off, and your expenses to own that property go down to being just taxes and insurance. You no longer have a principal insurance payment on your mortgage, but that tax and insurance increase over time, but it's less than probably what rent would be. So you can see your cash flow on just this one property is negative because you're supporting it, and then it is less negative when your mortgage is paid off. Now, that's this one right here. I'm going to toggle that off. Now, these are the cash flows on your rental properties, and I'm just going to do the first one. So this is just your first rental property. In month one, you don't have a mortgage payment because your mortgages are paid in arrears. So the first month that you own the rental property, you don't have a principal and interest part of your payment due. Your interest needs to accrue for the first month, so that on the very first day of the second month, the interest for the first month is then due. And they get it back at the end, but that's why they have this spike here. And then after that, you have a cash flow of about $99.33 per month starting in month 16. And so you're making about $100 a month. This is after taxes, insurance, maintenance, vacancy, property management. This is like literally after all of your expenses in your property. So we got all that stuff, and your property values, you continue to do this. Rents bump up after a little while, and now you're making $127 a month. If we adjust for inflation, you can kind of see what those numbers look like. So you can see that this is after you adjust for inflation. And what happens here is you end up paying off your mortgage. Your mortgage is not paid off. Now you have a free and clear property with a lot more cash flow, with which this stuff actually helps with funding your retirement money. Before, we were taking money out of our stock market account. Now, because we have income coming in from all these rentals, we do not need that as much stock market money in order to do that. And that's why you don't run out of money. Okay? So this shows you all the different rentals as you acquire them. And when they get acquired, you can look at any one of these. You can toggle all of them off if you want to, and just look at 2 and 3 together, or whatever you want to do to see that. If you want to stack all of them on top of each other, you click that stacking button, and now it shows you a sum of how much your total cash flow would be. So it could show you, now you've got, in month 300 or so, you have $6,306 of cash flow coming in, and that is in raw dollars. If we do inflation adjusted, go back to the month 300. You can see that's about, where is it, 300? Mouse is super sensitive. $2,414. So by the time you get, 20 years in the future, let's see, 240. 240 would be 20 years in the future. This is when you stop working. You say, listen, I'm done. Then you have $1,546 of cash flow coming in from your rental properties, including the one that you live in. So let's turn that one off, because that one really doesn't count. And then we'll look at, let's just do this. Let's just zoom into month 240. Yeah, see, now it shows you just month 240. And you have 2221 coming in from your rental properties by the time you stop working. Okay. Now, I'm just going to play around with you for a second here. There's just more stuff I want to do, but I just want to show you some cool stuff. So when we look at this chart, got ahead of myself. When we look at this chart, you can see net worth just kind of goes away. It continues to go up and up and up, and you're totally fine with planning for your retirement if you stopped working at 60, right? Because that's not what we basically said we're going to stop working at 60. So let me go ahead and do this. Let's just say we bought the 9 rentals, but we're going to stop working at 50. So we're 40 when we start this. Now I'm going to go change that income and see what happens if I stop working at 50 and what happens there. So I'm going to go down to my income stuff and I'm going to find the one where I am making $5,000 a month. Here we go, $5,000 a month. And we said originally that this was going to go only for first 20 years. Now I'm going to say this only goes for 10 years. What happens now? Are the rental properties able to kind of keep us going if we only work 10 more years? That's super interesting to ask. Let's see what happens. So we still bought 9 rentals. You know, spouse still does a side hustle. We still got Social Security coming at some point in the future. And stock market is still variable. But what happens if we just stop working at 50 instead of 60? Because we were working at 60 before. Do we have enough? Oh, we do. Isn't that interesting? So it looks like we're able to overcome that because the rentals will eventually have enough income coming in to more than make up for that shortfall. And we had enough money in our bank account. We'll look at it. We had enough money in our bank account to kind of pull money out of those savings. Oh, no, we didn't actually. Oops. This is crazy. So in this case, we didn't have enough. There was a period of time where we needed extra cash. A lot of extra cash because we didn't quite have enough to do that. So this is interesting. So we actually ended up having to come up with extra money out of the system when we did this. So we cannot stop working at it. And in fact, let's go look back. I mean, maybe I made a mistake and maybe we didn't have enough even at the 61. Did we have enough money? Let's go look at our account balance. Oh, we did. So working till 60, we were fine. We didn't need to tap into our stock market account in order to, we didn't have to actually bring additional cash into the system in order to do that. But when we stopped working at 50, and it's possible part of that's stock market return, right? So let's go ahead and bump it out a little bit. And this is why you need to do Monte Carlo. You need to do like 100 runs to see what the variations are. I will run this again, see if it still works that way. But then I will also make a copy. I'm going to say stop working at 55. See what happens there. And we'll go down to our paycheck. And if my math is right, 55 is 180 months in the future. We'll run that again. And we will see if we have enough money with this stock market sort of happening randomly. If we have enough money and we're able to retire. Because it really depends on how the market performs, right? Which leads me into our next conversation. So after we're done with this, I'm also going to say real estate appreciation, 3% every single year, doesn't seem very realistic to me. I definitely know that we can have years where it goes up more than 3% and years where it doesn't go up 3%. In fact, it may go down in value. Before I do that, though, there's so much stuff to do. All right, let's take a look at this 55. We'll look at the 51 again first. We're going to do 50 right now. So in 50, running it again, yeah, we still ran out of money. It shows that the cash account is basically any money that you didn't have enough for. It goes into your cash account, tells you, hey, listen, you need to come up with this additional cash. In this case, we need a lot more money. Let's see what happens with the 55. Do we have enough money? Go to the account balance. Oh, we did need a little tiny bit of money. So even 55 was too aggressive. So we'll go back. We're going to ignore these ones, and I'm going to build on number 7. Okay, so I'm going to ignore stop working at 50 and stop working at 55. We're going to say we're still stopping working at 60. Okay, so I'm going to make a copy of this, and I'm going to add in a market correction. Let's see here. So this was 7, 8, 9. I think this is 10 now. Oh, and I probably should have did the numbers with. So we'll add in here market correction. Oh, seemed to work. I hope. All right, so market correction. Let's go add a market correction here. So market correction is just another rule. And we're going to go ahead and add this rule in here. And we're going to say other rules. Market correction. Oh, that's interesting. Market correction. And we're going to run it for the entire scenario. Yeah, I should probably renumber those. I'll go renumber those quickly. So 1 out of every X months. So how frequently does a market correction happen? You know, how frequently do we see a big dip in the real estate market or a big dip in the stock market or a big dip in both? And for the sake of this particular, scenario, and you can model this however you want to do, I'm going to say, every 10 years, we're going to see a pretty big dip in the marketplace. So I basically say 1 out of every 120 months, and it's random. It can happen more frequently than once out of every 120 months, but we're going to say about once every 10 years, 120 months, we're going to see a big decline in the market. And we're going to say it happens to both the stock market and also to the properties, both our properties that we have here. Now, if you're doing really crazy, sophisticated investing, like you're investing in, one real estate market and another real estate market and a third real estate market, and you have properties that you own in different markets, you can have different frequencies of market corrections for different markets. So let's say you believe that the Northern Colorado market is prone to market corrections and that we're going to see more frequent and more severe market corrections just in those. You can say the properties that are in Fort Collins, just by clicking off which ones happen and they're more severe and more frequent. And then maybe ones in Florida or whatever it is are not going to be, or vice versa, whatever you want to do. Okay, so you can do all that. This has some instructions on how to do it, but we're going to say the market is going to correct somewhere between 10 and 20%, or 10 and 25%. Let's do it that way. So the minimum amount is going to correct is 10% down, and the maximum is going to correct is 25% down. And we'll say, the standard deviation is somewhere in the, most of the time it's going to be within 5% of the median of that, or the average of that, and 0.1 for the step value. So we'll do that. We'll save it. And so the average market correction will be about 17%, but you can have ones as, big as, or as little as 10%. And you can see ones as big as 39% or so that we're seeing. Oops, is that 39%? No, it's 25%. So as little as 10%, as much as 25%, and the average is going to be about 7% market decline. And it's going to be random. So let's go ahead, back to our thing, and we're going to run the analysis on that. Okay, so while it's running, I'm actually going to rename these. And I'll show you why here in a second. Because I want them to show up in order. I'm going to name them 0, 1, 0, 2. This computer sort numbers weirdly. My friend Brian tells me it's not weird. I'm weird. But I think it's weird that they do it like this. You would think that they'd sort by counting stuff, but it really doesn't. Just doing that. Go back there. See, that's why, because it's showing 10 there. So we'll do 5. We'll go 6. Now I'm regretting making 3 6s. Okay. 6. You know what I'll do? I'll come back and I'll finish these when I'm waiting for the next one to load. But for now, the market correction is done. So let's go take a look at that. So now we look at this, and whoa, this is crazy. Now we see some significant market declines where we've got big drops in our account balances and our real estate values and stuff like that. And because we've got these pretty significant declines in market, that's really scary. This is basically saying we have these random market events that happen once every 10 years where the market can go down 17%. Now, think about this. Have you seen a lot of 17% declines in real estate values? I think we've seen some, but are they every 10 years? Probably not, right? Have we seen 17% declines in the stock market values? Sure. There's been days when it's dropped 17%. So what I'm going to do is this. I'm going to go model what I think is a closer fit to reality. And I'm going to change this. Where's 10? Market corrections. I'm going to go ahead and make another one. And I'm going to change our market corrections more realistic, in my opinion, market corrections. Okay? And so what I'll do in this one is I'm going to say, hey, market corrections here. I'm going to keep the same market corrections that we had before, but I'm only going to apply that to the stock market. So once every 10 years, we're going to see a pretty significant decline in values in the stock market. I'm going to go ahead and save that one. But I'm also going to do, I'm going to make a less severe market correction. Excuse me. Less severe market correction for the real estate stuff. So, did I not save that last one? It's making me nervous. All right, so I'm gonna just do stock market. I'm gonna take off the stock market, and this one I'm gonna say the real estate market correction is gonna be 0 to 10%, with 0 being the minimum and 10% being the maximum, and we'll say it's usually around 5% decline, and instead of being once every 10 years, once every 10 years seems good, and then I'll do that and we'll see what happens. All right, well, I got some code error, but this should actually untoggle. So something needs to be fixed. But what I will do and make a note to fix that. And then I will go ahead and I'll do it a different way. Okay. So for market corrections, we will do, I will delete both of these. Go back to scenarios. This is number 11, more realistic market corrections. And I will remove the other market correction one. All right, now what I will do is I will add them back in and we'll only apply it to market correction 11. Here we go. All right, now what I'm going to do, I've removed the 2 market corrections I had added before, and now I'm going to add them back in, but I'm going to add them in 2 parts. The first part I'm going to do just market corrections on the stock market. So this is going to apply just to 11. And 1 out of 120 months, same as before, just the stock market. And we're going to say it's going to be 10 to 25, I think is what we had before, right? 10 to 25. We'll do 5 there. That seems about what we had before. So that'll just apply to the stock market now. Now I'll go through and I'll add one into the properties. And we will add another rule. And we will do market correction. And we will just do number 11. And we'll do still 1 out of 120 months. But we're not going to do the stock market. We're only going to do the properties this time. And we're going to say it's going to be between 0 and, what did we say before? 5%? 0 and 10%? Let's do 0 and 5. 0 and 6. And minimum is going to be 0. Maximum is going to be 6. And we'll say it's within 2. And we'll do 0.1. So this is a more mild correction to real estate values because we don't typically see 20% declines in real estate values in most markets. And so no, this just applies to the real estate stuff. It's still only happening once every 10 years on average, and it's random. And then it really could be a up to 6% decline, but most of the time it's going to be in this 3% decline area that we're seeing. Okay. Now we'll rerun that. And while I rerun it, I will renumber some stuff so that it shows up in order. 6, 10. So let's do it right now. No, this 6. And go back to the scenarios. We'll do 7. Go back to scenarios. Still doing it. Do 8. Go back to scenarios. Still doing it. 9. All right. I think we're all renumbered. And just in time. So number 11 is done now. So let's go take a look. Oh, look at this. That's much different than we saw before. So now that we only have market corrections happening on real estate less frequently and less severely, but the stock market one can still be impacted pretty significantly. Let's take a look at what our account balance looks like, see if we can spot some market corrections. Now, these might be market corrections over here. We're not needing any. Oh, look at this. This is super interesting too. In this case, because we had some of those market corrections, we had a period of time when we were short. Our account balance actually went down to 0, and we needed to add $5,000 to the account. So even with this one working till 60, you got to the point where you were so close that your account balance went to 0. And you needed to come up with, $6,000. You needed to do some type of side hustle, or maybe you need to refinance the property, or whatever it was. You ran out of money for a period of time, and this is at, this looks like it's basically right around that same time when you stop working, because here's where you really 240 is where you really stop working, like right here. You stop working, you had enough money to support you, then you were short, but then eventually your rental property and stuff like that kind of overcame it. So, and if you run this again, it's going to be slightly different because it's random. I mean, the stock market number is random and stuff. So that's super interesting. Let's see here. I was going to check something else. I was going to check your... Oh, you know what else I want to show you? Is when you buy your properties can vary now that you have these kind of like market corrections and stuff in there as well. And if the real estate prices go down, it means it's cheaper for you to buy the property, so you could end up buying it faster. So I'm going to compare that to just buying 9 rentals before we did the market corrections. Yeah, you could see that in the one where you had more realistic market corrections, it ended up taking longer for you to buy your properties compared to when you just bought them and we didn't have the market corrections in there. And it could be the other way. It could be that the market goes in your favor. You don't have market corrections early on. You're able to save up more money. You're able to buy your properties, or maybe there's a real estate market correction before you buy, and you're able to do that. And so each time you run this, your results will be slightly different. And that's why you want to do the Monte Carlo, to get a range of what your values are. And in my opinion, when you run the Monte Carlo, you want to see situations where you are not running out of money in all the runs, because it would be bad for you to run out of money. I mean, if you're planning for your retirement and, half the time you run out of money and half the time it looks amazing, I'm not so sure that's a strategy you want to do, which is why you really want to do this modeling. You don't want to just go buy properties and say, I hope for the best. We've seen 3% appreciation. Yeah, maybe not. Speaking of which, let's do that next. So we did these market corrections here. Now I'm going to make a copy of that, and I'm going to say, this is going to be 12. I'm going to say appreciation and rent appreciation variable. Right? Before we've been saying, hey, listen, the rents are going up at 3% a year. That's fixed. The house values are going up 3% a year. That's fixed. Now I'm saying I'm not so sure. We could have years where rents don't go up 3%. Maybe they go down 2%. Or the property values don't go up 3%. Maybe they go up 6%. Maybe they go down 3%. So I'm going to do the same thing. I'm going to add a rule, and I'm going to set the value on the properties now. And I'm going to apply this just to number 12. And I'm going to do all properties in the scenario. And I'm going to say the appreciation rates. And I'm going to pick from a random value from a normal distribution. And I'm going to say, I'll just plug in some numbers and see how it looks. Let's see, it could be as low as -6, could be as high as +9, and the minimum will be -6, +9. Let's see, and let's do the standard deviation of 3. And step value 0.1. Let's see what happens here. Let's see what the average is, because I want the average to be around 3, right? Because I believe that over a long period of time, the average is going to be around 3. So this average is 1.4544. So I'm going to change this a little bit. I'm going to say, the minimum is going to be, let's do positive 12. Kind of bump it up a little bit. Yeah, so this is about 3, okay? So in a really, really good month, the yearly appreciation rate is going to be about 12%. In a really, really bad month, the yearly appreciation rate can be -6, okay? But overall, it's going to be around 3% per year average, okay? And I'll use these same numbers for rent, because I believe rents and property values are about the same. If you don't believe that, you could change it. So we're doing -6 to positive 12. Oh, we should change this here. -6 to positive 12. Make sure it's still around 3. Yeah, it's still around 3. And standard deviation, 3.1. Okay. So got this one. We'll go back to this scenario. And this was a rule for setting values on properties. I'm going to make a copy of it. And I'm going to do appreciation rate. I'm going to do rent appreciation rate as well. So I made a copy of this rule, all the same assumptions, and I'm going to save it. And now it's going to do rent appreciation as well. So I should have 2 rules down here at the bottom. Set value on properties. One of them is for appreciation rate, and the other one is for rent appreciation rate, somewhere between -6 and positive 12. 3 standard deviation plus or minus 0.1, sort of like that's how we're doing it. And then here's a min or max. Okay, so if I go rerun this scenario, let's see what happens now that we have that in there. Oh, there it goes. So now it's going to run and do that. And let's see if it's done. It is not. What if you thought that the real estate market was overpriced right now and that you're much more likely to see a market correction in the next 5 years? How would that play out with either scenario? Well, you could do what we just did. You could add another market correction in there, but only run that one for the first 5 years and make that one much more likely. So you could say, instead of being 1 every 10 years that you see a market correction, you could say, hey, listen, we're only going to run it for 5 years, but 1 out of every 5 years, we're going to see a market correction, and put in there what you think the market correction might look like, and then run that. And you could even keep that in addition to the regular market corrections you might see as well. All right, in the meantime, let's take a look at how this changes when your property values go there. And let's, since we've been seeing that we've been running out of money with some of these, let's go check our account balances first and see if we ran out of money. We did. We needed to add money to this. So what this shows me is, running this even just a few times, that we're running out of money when you stop working before 65. So either you need to buy your houses earlier, so you can get your rent coming in earlier than that time, which you could do by not putting 20% down, which opens up a whole nother conversation. We could do like nomad strategy where you're buying properties every year with 5% down, and that would probably solve your problem. Or you need to save more, or buy down your interest rate to get more cash flow coming in from your rentals, or put your money into something that's not as variable, or you get a higher return somewhere. So these are different things you can do. Or you could decide to work later, right? You could decide, instead of, hey, listen, I'm not retiring at 60, I'm retiring at 65 when my Social Security kicks in, and then you're much less likely to run out of money doing that. Okay. All right, so now when we looked at owned properties, we can look at the appreciation rate. Before it was static at 3. Now we can see the appreciation rate for each individual property is variable. And so if I only wanted to look at like the first one, I'll just pull up that one just so you can see one instead of all of them. Now you can see that the appreciation rate for the property is variable. It's hovering around 3 on average, but that each month it's different. Okay? And this shows you all the different properties. So you can see each one has its own appreciation rate. Sometimes that property goes up more, sometimes it goes up less. So you can see that. What's interesting, you can also dig down and say, show me the actual appreciation, how much money the property went up in value. And you can see that it's growing increasingly larger over time because the property values are increasing. If we adjust for inflation, they should be more static, right? So that's there. What else can we look at? Let's look at cash flow, because now rents are going up at different rates too. So this shows you your cash flow over time. This one property is the one that you live in, so we don't have to worry about that. And we're also showing inflation adjusted. Let's do raw dollars. Now this shows you that your cash flow is irregular. When you go to renew your leases, it's not always up. There are times when your rents are down. And so your cash flow definitely varies a lot more. And we can kind of stack this on top of each other to see what the overall cash flow is. But you can see it makes a big difference, because not all the time is it completely up. If we go, let's do a comparison. Let's go ahead and do this. So when we just bought the 9 rentals before everything was variable, let's pull up that chart. This was showing you where your rents were pretty static. So total monthly rents. So this shows you a chart of what your total monthly rents are for the rental properties when we just bought 9 properties, but rents were not, the appreciation rate for rents was not variable. Let's compare that to now rents being variable, and you can see the difference. Yeah, you can see that it's the one with orange shows you that the rent is variable. The rent appreciation rate is variable. And so in this case, it ends up being lower, but it gets to be a point right in here where it's a little bit higher. But overall, it's lower. So you can see the rents do vary over time. And these are some of the kind of like stress testing you should do to your particular investing strategy. You should find out how your particular portfolio will perform with this. So, speaking of comparing portfolios, if you were going to say, hey, listen, I want to buy 10 properties versus I want to buy 12 properties, or I want to pay off my property. I have to get to paying properties off early. We haven't even done that yet. Let's say you want to compare 2 different strategies. One where you pay off properties early versus one where you do not pay your properties off early. Which one is better for you if you decide to take your money and put it in there? And you can compare those side by side. What was I going to say about that? It was important, but I forget what I was going to tell you. Oh, you need to stress test your portfolio to do this, to see it. And one of the things that I like to do for looking at your stress testing is I like to look at how much risk you have in your portfolio. And one of the measures for risk, not the only measure for risk, but one of the measures for this risk is your debt to net worth ratio. So it takes a ratio of how much debt you're holding compared to what your total net worth is. And now you can go and look at 2 different investing strategies. And this one, it's less germane because you're just comparing the same strategy, but one where you have rents and appreciation being variable, and you can see the difference that even that makes in looking at how much debt to net worth you have. But if you're doing a strategy where you're going to do nomad versus putting 20% down, or 20% down versus 25% down, or paying off properties aggressively with cash flow, or paying off properties if you have enough in your account to achieve your financial independence number or something like that, then seeing how that impacts your debt to net worth or a measure of risk is critically important, because a scenario that gets you to your end goal with less risk is better than one that gets you to your end goal with higher risk. And so those are some things you need to definitely look at. Okay, where was I going with this? So we could do some crazy stuff in here, and just for fun, I'm going to go ahead and do it. So let's say you decide, I'm going to do the same exact thing, but I'm going to wait 5 years. I think the market's a little frothy. I'm going to wait 5 years before I start buying. So let's go ahead and just see what happens if we do that. So wait 5 years before you start buying rentals. This is something I hear my clients tell me relatively frequently. I think the market's too hot. I'm going to wait. I'm going to wait for a dip. And you don't know when the dip's going to come, and so that's the problem, right? So let's go ahead and do buy properties when we have the account. And this is the one we want to modify. So this is the rule we had before, where we said, hey, listen, as soon as we have $5,000 plus that 20% down payment plus the closing costs, start buying rentals. Buy 1 rental, and if I have enough the next month, then buy another rental, and stop when I get to 9, okay? And I said start doing this rule in month 2. Now I'm going to say, start doing this rule in month 60. So I'm going to wait, or let's say it's 61, right? Because someone's going to say to me, someone's going to watch the video and say to me, James, you said after 5 years. You didn't say at 5 years. So, okay, it's after 5 years. So basically 61 months. And I'm going to run the analysis again. And I will go ahead and compare that to the one where we have appreciation, rent appreciation. And what's crazy about this is this, right? You go and you run this, and you may see that, hey, waiting 5 years doesn't matter, but that may have been because you didn't have a major stock market correction early, or it may have been because you had a really good real estate correction during that 5 years and it looks better. But if you ran this 100 times, like doing Monte Carlo, and you saw your results, it may not be a universally true thing. And that's why you need to look at this stuff. You can't just, oh, I'm gonna wait 5 years. It works out better that way. Maybe not. Maybe not. Let's take a look now. All right. So this shows you your net worth if you waited 5 years. I'm going to jump right to that account balance to see if we actually needed to put money into the system here as well. And sure enough, looks like we still did. So that's problematic. I think you retiring 5 years before you start collecting your Social Security or whatever it is really draining your balance there. So we might actually want to go and bump up your retirement so that you're not stopping working at 60. Maybe you're working until 65, and then you have your Social Security coming in. Then your target, you're kind of like your level to overcome that really goes. You're kind of like your like stick to kind of measure to get over your target jumping height, whatever it is there. So, all right, let's see what we're doing here. If we did that, let's do this. So I'm not going to do the wait 5 years before buying rentals. I'm going to make a copy of the one where we were buying them regularly. And I'm actually going to start paying off mortgages with cash flow. So 14, pay off mortgages with cash flow. All right, so what I'm going to do with this is I'm going to add a new rule. And I got to be careful about this rule because I don't want to start paying off the mortgages and put myself in a weird situation where I get in trouble with running out of money earlier. Or maybe that's what's going to happen. So here we go. I'm going to do pay down loans with cash flow. So this rule says, and I'll run it for the entire scenario. I'll run it just for 14. I'm going to take the money out of the stock market account. And I'm going to say, anytime I have more than, I don't know, $100,000 in my account. Anytime I have more than $100,000 in my account, adjusted for inflation, I want to pay off the lowest balance mortgage first. So I'll take anything over that $100,000 threshold, and I'm going to apply it to paying principal down on the mortgage so that I get to free and clear mortgages faster. Okay? And I'm going to just run that rule. And then when I'm done paying off the first one, it'll go to the next lowest mortgage balance, and it will continue doing that. So what happens if I go ahead and I start doing that? I don't know the answer. So let's find out. This is like live without a net. I'm just making up stuff as I go. Let's see what happens with it. And this is part of the fun, right? I mean, basically you get to go play around with it and you get to say, hey, what if I try to pay off my mortgages? And then you got to go look and say, what is happening here? Why am I running out of money? And then you got to work backwards and look through things and see stuff. Like I'll give you another example. I'm going to go into an older one. When you look at the accounts, you can go drill down and look at the account ledger to show like what happened, right? So the stock market, you had no return that month. You had personal expenses. You had $4,000 come out. That's your new account balance. Here's your paycheck coming in. Here's your closing costs for buying the property. Here's your down payment. Here's your mortgage payment. Here's your property taxes. Here's your property insurance. And then it shows you month two. And you can go drill down into what happened in your account for each month to really follow along if you wanted to. And that's that little link right here for the account for a scenario. All right. Showed you something there. Let's see if this is done. Should be. It is done. All right, let's take a look. So paying off mortgages with cash flow. Interesting. Let's see if I ran out of money. Interesting. So in this particular case, with the random numbers we had for returns and market corrections, stuff like that, turns out I did not run out of money where I needed to add money to the system. So that's encouraging. Let's go look at mortgage balances to see what happened here. We'll try to figure out what I was doing. So here are the mortgage balances. So I had This was the property I lived in, and we had a 5% down payment mortgage, so the mortgage balance was high. So it looks like I never got around to paying this off more than what I was normally going to pay off on the mortgage with just my regular payments. So that one didn't happen faster. This one didn't happen faster either. This one didn't happen faster. This one did, though. So you can see this one, I actually got to the point where I had enough money and it was a relatively low mortgage balance. I started paying this one off faster. Now, normally, if I had done my static 3% appreciation rate, it's likely that this was the first one. The first rental property I bought would have been the one that was most likely to have a mortgage balance get paid off. But in this case, it turns out that this was a lower balance for some reason than the other one was. So we did lowest balance first. Did I do lowest balance first? It's almost looking weird to me. Let me make sure I didn't click on the wrong thing. Payoff. Payoff loans and cash flow. Stock market. Payoff. Lowest balance first. Okay. Yeah. Okay. So it's doing these, and so you can see it's starting to pay off these mortgages pretty aggressively later on. But it doesn't look like you're paying off mortgages before you get to the point where you've stopped working. Because remember, you're stopping working at like 240 or sometime in here. So it doesn't look like you're paying off any of these mortgages earlier than that. It's really after you start accumulating some money. So this must have been a case where the stock market was really kind to you, and you were able to do some stuff. So that's probably what's happening in this case. So that's mortgage balance. And you can see basically that the mortgage payment goes away once you pay off the mortgage. You can see that these are shorter, so you don't have mortgage payments on those anymore. All right, so we did that. What if instead of, well, I guess it really didn't have an impact, but we have another rule where you could pay them off, but only when you have enough money to pay off the mortgage in full. And so that's an interesting idea. I wonder if that actually, let's try it out. So I wonder if paying off the mortgages in full will get you there faster. So let's go ahead and do pay off mortgages with cash flow. I'll make a copy of that one, and I will delete this pay off mortgages with cash flow. Go down to the bottom here. Paid off loans with cash flow. We'll delete this rule and turn this off. Now we shouldn't have a rule for that, which we don't. I'll add a new rule, and I'll say pay down loans, pay off mortgage in full. So this rule basically says pay off, look in your account, and if you have enough, I'm not going to set this at, I'll set it at 100. If you have enough money to pay off the mortgage in full, pay it off. But if you only have enough to pay off half of it or a little bit of it, then don't pay it off. And so that's how this rule runs. It basically says only do it if you have enough to pay it off in full. So when that runs, I'll do that. And while I'm waiting, I'm also going to do another one. So we'll sort of front load making these. Pay off mortgages. So sell houses and pay off mortgages if it means I can retire. And I'll delete that other rule of for this one. Okay, so I'll go ahead and add that rule here in a second. Let's see if the other one is run. It has not run. Oh, yeah, it has. Pay off mortgages only in full. So let's go ahead and run this one. Let's go look at charts and see what happens. Okay, looks like a decent net worth. Did we have enough money to do this one? looks like we did. So we had enough money to do it. Let's take a look at the mortgage balances. Yeah, so this one basically says we didn't really have enough money till a little bit later in the game here, but this one looks like it just paid off in full. This one looks like it paid off in full. This one got paid off in full. This one got paid off in full. This one got paid off in full. 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 Oh, so this is super interesting. So this one actually ended up being paid off really early, month 307. So by waiting and letting your money grow in the stock market at a higher interest rate, in this particular example with the stock market random returns and appreciation rates and things like that all being random, this one showed you that you were able to pay off the house you live in month 307, and that significantly impacted your ability to pay off the other ones right after that. So then you get to pay off this one, and you saved up enough money, and this one, 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 and so on. Okay. All right, so that's charts for that. Let's go ahead and do this one. So sell houses to pay off mortgages if it means I can retire early. So we have another rule here, and the rule says sell properties and pay off mortgages to retire. So I'm only going to apply this to 16. That's the one we're doing. I'm going to look at my stock market account. And what this rule basically says is, hey, look at how much I would need to have in my bank account and in free and clear rentals, cash flow from the rental properties. And if I can sell off some of my houses, not necessarily all of them, but if I could sell off some of my houses, use that money to pay off other ones, or have the rest of that balance in the stock market, if I can do that, and it would mean that I could hit my target monthly income for retirement number, that $5,000 a month that we set up there, adjusted for inflation, then go ahead and sell those properties, pay the taxes, pay the real estate commission, pay the depreciation recapture, and use that money in order to pay off the properties and hit my target monthly income for retirement. So what this basically says is this is what your closing costs are. We'll call it 1% of the cost of the property to sell when closing. Your real estate commission is going to be 6%. Your depreciation recapture tax is 25% of the depreciation you took, and then your capital gains rate is 15%. Of course, you can adjust all these assumptions. So if you're going to, sell on a lease option or do something else creative, you can remove your real estate commission. If you've got a different capital gains rate because you're, under a certain income or over a certain income, you can adjust those as well. But really, this is what that rule will do. So if I save that and I run it, I'm going to see if this will allow us to get to the point where we can retire. And in the meantime, I'm going to do this for goals. I'm going to make sure we've got this property added to our goal. So you want to make sure you've got, you're tracking which ones should be included in your goal here. And so I'll rerun this puppy, make sure. As soon as it's done running, I will check it out and we'll take a look. All right, check out the chart. So that's pretty interesting. So that looked good. What about account balances? Did we run out of money? Did not run out of money. So let's take a look at our goal. When did we achieve financial independence? Yeah, so right here is where we achieved financial independence, and we probably had like a little mini sell-off that went on here. Let's compare that to, let's run the previous one again just to make sure it's updated with that new goal. Actually, I'll run all of them again. Make sure that we have all the goals redone. And then I'll go and I'll compare this. In the meantime, let's take a look at the owned properties and see what, actually, let's look at this. Let's look at how many properties we own at the end. Because we bought properties. Oh, this is super interesting. So we bought properties. This is the one we owner occupied, and then we started buying rentals, kept buying rentals. Eventually, we got up to the point where we had 10 rentals. We held the 10 rentals for this period of time, but then right here, we said, hey, listen, we've got enough. If we go sell off some of our properties, in this case, it looks like we sold off 3 of them. If we sold off 3 properties, took those proceeds after we pay taxes and depreciation recapture and transaction costs and everything, and we use those to pay off the remaining properties, we'll have enough money so that we're going to get to the point where we're very unlikely to run out of money because our safe withdrawal rate and the cash flow from the free and clear rentals is better. And then we even went and replaced them. We bought more because our rule was still running, saying buy properties once you get to 10. So we did this and we got to a very stable position with cash flow. And then we said, hey, let's go ahead and acquire more. Let's go back up to 10 so that when we eventually pay off those, the cash flow looks much better. And so that's just what happened there. We ended up acquiring 10, holding them for a period of time. We got to the point where we could achieve financial independence and retire. We ended up selling off 3 properties and paid off some other ones. And then we went and bought 3 more properties over time. So let's go take a look, make sure all these are done running. Which most of them are. Maybe not all of them. So wait for those to keep running. So let's go look at owned properties. Let's see the mortgage balance of these. Just kind of take a look at that. So yeah, this is super interesting. So these are the property 12, 11, and 10. We weren't paying those off. Property 9, we ended up paying off the mortgage. Property 8, we paid off the mortgage. Property 7, paid off the mortgage. Property 6, we did. Property 5, we did. Property 4, we did. Property 3, we did. Property 2, we did. Property 1, we did. And we did not pay off the mortgage on our owner-occupant property. That's usually not included in that calculation because the one you're living in doesn't improve your cash flow. It doesn't improve your cash flow in that you don't have an expense, but it doesn't improve the income part of your cash flow. So let's go do this. Yeah. All right, so what I'm going to do is I'm going to compare the goals that we had for, this is when we achieved financial independence, where our investments were enough to make sure that we had that 4% safe withdrawal rate and the cash flow from our rentals would be enough. What if we did paying off mortgages but only in full? How does that compare? Yeah, so the paying off mortgages in full took longer to get to the point where you were at retirement number. So it took till month like 440. Well, it shows down here, 420 versus 375. 375 is the time you hit it if you sold houses and paid off mortgages to retire and did that. And you can see too that eventually the cash flows looked very similar toward the end because we ended up acquiring more properties even after we hit our number to retire to do that. So we got that one there. What if I added another one here? Let's look at the one where we did paid off mortgages just with cash flow. How does that compare? So pay off mortgages with cash flow. Yeah, it turns out in that case, you get to about the same point, but it turns out to be better than the other ones here. So you end up keeping the properties and doing that. That's the yellow line here. So you could see 420 versus 375 if you sold off the properties and 368 if you got them with cash flow. So turns out paying them off with cash flow in this example, by the way, and I've seen it go the other way, and part of it is how did the market perform for you? Because if you run this 100 times, each time it's going to be different, right? Because sometimes the real estate market is up and down, sometimes the stock market is up and down, and whatever works out for you is working out for you in that case, and it's not always the same. I mean, because the market performs one way, it could be better for you to do the other strategy. So that's why you got to look at this stuff. Let's see here. We talked about that. Talked about that. Oh, here's another interesting one. Let's do this. Let's go ahead and look at this last one we did. Pay off mortgages if it means I can retire. And I'm going to look at your return on equity. So this shows you your return on equity for your property over time. You know, that's weird. It's weird because we're selling off these properties and your return gets wacky. Let's not look at that one for now. Let's do the ones just where we're paying off properties with cash flow. And then let's look at return on equity. There we go. A little bit better. All right, so now there's 4 different returns on equity. And you've got cash flow from depreciation, cash flow, debt pay down, and appreciation. So this shows you the overall return on equity for all your rental properties that you're seeing. And so it takes the total dollar amount of appreciation that you're seeing and divides by the total amount of equity you have to see what your return on that equity is. And so you can see over time, your return on equity goes down because even though the dollar amount of appreciation that you're typically seeing is going up, the equity you have in the properties is also growing, and that's growing faster typically than the appreciation rate is. And so your return from appreciation typically goes down to when it's paid off in full, then you're really getting the raw appreciation number, an unleveraged appreciation return. Same idea with debt paydown. You only get a return while you have loans on the property. Once you get rid of your loans, you no longer have that return from debt paydown. And so that's why, and these are paying off the loans with cash flow, it bumps it up as you kind of pay some stuff down. And then you basically get to the point where you no longer have a debt paydown return when you don't have any more loans. Here's your cash flow return. Your cash flow tends to be higher in the beginning, and then eventually it gets up to the point where it's on equity, it tends to increase a little bit. That depends on what side of the curve you're on, I guess. So this tends to be your cash flow number right here, and so you can see your return from cash flow going there. And then your cash flow from depreciation, you get to depreciate these properties over 27 and a half years, and so that sort of declines and goes down to the point where you no longer get depreciation benefit from any of your properties. However, if we look at all of these together, and we stack them on top of each other, what we're looking at is the overall return we're getting on these properties. And if you really wanted to, you could say, look, when my return gets below like 10% on a property, if we sell that property, buy a new property, and only put 20% down, we re-leverage up and we move closer to this higher end of the return on equity curve. And so you could say, anytime I have a property where the property itself drops below a 10% return on equity number, sell it, pay whatever fees I have to, and buy another property to do that. And so let's go ahead and add that rule. So I'm going to go ahead and do I'm actually going to not do any of the ones where you're paying off mortgages with cash flow. I'm going to change that. I'm going to just go back to the ones where we did the rent appreciation that were variable, and I'm going to start there. So I'll make a copy of that one. So we're not doing any additional paying off properties with cash flow, and I'll do this one. We'll call it sell if return on equity is less than 10%. And I'll go add a new rule for that. So sell properties based on return on equity. That's the rule we want. And we will run this for number 17, stock market account. Sell rental properties when return on equity drops below 10%. We'll say closing costs when selling 1%, real estate commission 6%, 25% depreciation recapture, and 15% capital gains. We'll save that, and then we'll rerun it. And so what this will do is it'll sell properties, and because we have a rule in place that says buy properties till we get up till 9 rentals, it'll replace it with a new property once we've sold it. And so once this rule runs, we will be able to see what happens there. Close this down, close this down. Did it run? Not yet. Should be running any moment now. There we go. We'll load up this one. Oh, that didn't work out very well for us at all. So in this case, let's take a look at the properties, number of properties owned. Looks like we... I wonder if there's something going on with my rule, because that does not look right to me. Let's go look at my return on equity rule. Sell properties based on return on equity. Sell properties when return on equity drops below 10%. Oh, you know what's interesting about this? Because we're using variables for our appreciation and our rent appreciation, if you have a month where the appreciation rate is negative, it is actually selling the properties off. So that's less than ideal because it is triggering this rule when we've got that. So what we really need to do is I'll need to write a new rule that looks back a period of time and says the average for the last 12 months is less than 10%. So can't show you that today. This is why we're at alpha. Fix return on equity rule to not sell based on 1 month. So I'm going to delete this rule, and we're going to pretend we didn't do this one, because that's how it is. So if you had done this rule, in fact, I could show you that. Let's see here. I'll delete it. What I will do is let's look back to before we did this appreciation and rent appreciation become variable. And we will, I wonder if actually it's going to be impacted by these market corrections too. Let's find out. I'll make a copy of this one. And we'll call this one sell when ROE less than 10%. I wonder if it's going to be impacted by the market corrections too. Let's find out. So sell rental properties based on return on equity. And we will only apply it to this one. Stock market account, 10%. Save it. Rerun it. Yeah, this is super interesting. So I've not used the return on equity rule when I had variable appreciation rates or variable rent appreciation rates, or even when I've done random market conditions. So this is pretty interesting because that rule gets triggered because our return from appreciation in that month was negative. So basically when that rule got triggered, it was selling all the properties off. So we really didn't have time to acquire many properties at all, because if you had even a negative month of appreciation that was big enough to make it the overall return drop below 10%, it was gone. Property's like, I'm out of here. I'm sold. So we shall see. I actually can delete this one, I think. All right. So there we go. So now this one, let's check our number of properties owned. And yeah, this is much more what I expected. So basically we acquired properties, got to 10, and then eventually we got a property where one of the properties we owned dropped below, the return on equity dropped below 10%. And so we ended up selling a property, but we immediately bought a replacement and re-leveraged up. And so we continue to do that. Each one of these little dips is us selling a property and then buying new ones to replace them. And it shows you that our return on equity now, let's see, I wonder if there's a total return on equity where it just shows it. Total return on equity. Yeah, I guess it's just all of them. That's probably the better one to do. See, now it actually keeps bumping back up. I'll stack them so you can see it a little bit easier. It keeps re-leveraging back up so that your return on equity is not likely to drop below this 10% number. And if we look at, here, I'll go pull up what we copied, the one right here. I'll show you what it looked like before we added this rule to sell. Return on equity. So you can see in this one, when we stack them, that it dropped below this 10% number. Properties eventually dropped below there, and it did that. And then here, you can see that it consistently stays above that because we're selling properties to make sure the return we're getting on our rental property stays high. Now, this does add risk, right? This is interesting too, because we talked before about this idea of risk, total debt to net worth. Where's total debt to net worth? Here we go. Total debt to net worth without selling the properties, your debt to net worth goes way down. When you do debt to net worth and you keep re-leveraging up, it continues to leverage, and so your comparison here, let me compare them. See? So your debt to net worth for the ones where we did not sell is much lower. We continue to take on more debt in order to get our return on equity up with the other model. Let's turn off stacking. Yeah, you can see this here, especially out here when you do it. You're continuing to take on more debt. Now, is it as extreme as early on when you didn't have very much net worth to begin with and you had quite a bit of debt? No, but it's still increasing your risk later on in your investment strategy. And you can see part of this, I think, is part of the variability of the appreciation rates and rent appreciations and market corrections too. But you can see how all these things would apply. All right, I think I'm getting up on about 2 hours. And there's a bunch of other things I definitely could cover. One of the things we want to talk about was the impact of buying properties at a 10% discount or getting 10K off, or what happens if you're buying a little bit better cash flowing properties, or you're getting an extra $100 a month, or you nomad or something like that. All these different things apply, and being able to evaluate the risk of them, I think, is pretty important. So I will stop here, and maybe I'll continue on with a couple new videos in the future doing different things. But this is something that if you want to go plug in your own numbers, just go to realestatefinancialplanner.com. You can sign up for a free account. You can plug in your own stuff. The more complicated modeling you're going to do probably would require a paid account, but you could definitely do some modeling on your own with a free account. And then, of course, if you need tech support, you want to get on a screen share and have me help you input your data so that it's in there correctly, and ask some questions about the technical side of how to model things. I'm happy to do that. It's just a consultation fee for doing that, and so you can do that as often or as little as you want. So that's it for now. I'm James Orr. Hope you enjoyed the video, and I will talk to you all soon. Bye for now.